Welcome everybody to our 20th episode for our Bay Area Housing Market Town Hall. And today is May 12th. As I mentioned earlier, we are really excited because we have Karen Mann to be here and talk to us about these appraisal challenges during a rapidly rising market. I can assure you that every single realtor you've talked to who have made an offer this year or last year have come into some kind of appraisal issues. So we're going to talk a little bit more about it so that you as a consumer or as a realtor can really understand how you can navigate these challenges. But before we start, let me see, all right, before we start, as we mentioned that we started this Bay Area Housing Market Town Hall since last year, March 25th, and this is our 20th episode. And we're really here to focus on providing education for you guys as the consumers and also sharing information with our real estate industry and professionals. I really believe that real estate education shouldn't be just within the real estate professional industry. It should be shared with the consumers as well, so we can grow together. So please do, hopefully you can invite some of your friends and families or other associates to join our webinar. Hey, don't forget to subscribe to our channel so that every month we can notify you whenever we have a new speaker to share very timely real estate market information with you. So stay tuned. Here, I don't want to delay any further. I get really curious. I want to introduce you guys to Karen Mann, who is a certified general appraiser at Mann and Associates. She's a provider of real estate appraisals, court expert witness, and has been in consulting for 41 years since 1980. She's the past president of the Northern California chapter of the Appraisal Institute, past president of the San Jose chapter of the American Society of Appraisers, currently serving as a public relations chair for the American Society of Appraisers. To date, she's still a practicing appraiser with a certified general license and provides estate dissolution and other valuation services. Well, welcome, Karen.
Thank you, Helen. Thank you for the wonderful introduction, and your overview was excellent. Probably the best I've heard yet. Very, very well done.
Oh, thank you so much. Thank you. I told you that, I do spend a lot of time on these. I want to make sure that I'm delivering what I think is fair. I don't want to be too subjective, but that's kind of like what we talk about, valuation sometimes is very subjective.
Well, I thought that you caught something that I've been talking about for about the last 6 months, and people don't realize it. We're watching the new home construction really just skyrocketing right now, and every new phase that they release, we're seeing price jumps of 10% or more. And so people are asking me, why is this happening? I said, well, one of the reasons is between, after the last national recession that we had, which was awful. After that, many home builders couldn't build. They couldn't get the financing from the commercial banks. For every reason possible, they were discounting and selling the lots. And so it was during about a 4-year period, maybe 5, that home building was flat, was absolutely flat. It may have gone backwards. Mm-hmm. And as your chart showed, which I thought was an excellent chart, it showed that the demand based on the population increasing 6% a year. And if your housing is not keeping up with that, or if it's going the opposite way, the whole supply and demand thing it can't help but it's going to erupt its ugly head at some point. And I think we're there.
Exactly. I know a lot of people have been talking about this bubble, and I mean, I'm not denying the fact that we have been increasing, the pricing have been increasing so much, and it does sound a little bit ridiculous, but we just have to go back to supply and demand. And when our clients ask us, oh, I think there's going to be a lot of foreclosures, and we always have to go back to them and say, no, foreclosures are not happening right now. People have so much equity in their property, they can actually easily sell them without going to foreclosure.
Absolutely. And one other thing is that the quality of the buyers in this market is so different than what we saw during easy money days from 2000 to 2007. What we're seeing today is that many of our buyers, or many of your buyers, are coming in with 100% down, paying, with cash, or 50% down, so that the effect of the appraisal being short maybe 10,000 or 25,000 doesn't have near the disastrous effect, because the people are buying it based on what they want, not based on a certain figure that you have to hit for the loan. So that really makes me happy. And since those people that have got so much in equity that they put the cash out of their pocket, that gives me more confidence, because that shows me that they've got something in the property. In other words, to walk away, it would be very painful to walk away with your investment.
Exactly, because in 2008, when that crash happened, the loans were 100%, and it was option arm. We have seen over 100% loan as well at that time. And honestly, as a homeowner at the time, if your value dropped, you didn't put anything in, why not just walk away? It's almost like you're just making business decision here.
Yeah, that's right. And we're not seeing that this time. So I agree with you. I'm not sure if I'm going to call this a bubble. It's something. And I'm not sure, because obviously, and I know that this trend cannot go on indefinitely. That's not how it works. And this is going on all over the country, by the way. This is not just unique. It's probably more emphasized here in the San Francisco Bay Area, because we are so very blessed to have the incredible technology from our Silicon Valley and from the outlying areas. And because of that, having that technology, the demand for employment is very strong.
Yes.
In the 1980s, no, let me back up. It was the early 90s. I've been at this too long. In the early 90s, we had a technology bubble. In other words, Silicon Valley was on the upswing. We thought that they were just rolling strong, but then they had a hiccup in 91, 92, 93. And when that hiccup happened, a lot of Silicon Valley people lost their jobs, or they had to get creative and reinvent themselves. So the big push for employment back then went away, and which affected the housing values in the Bay Area, starting from Silicon Valley working north. But I'm not seeing that this time. I think that the technology, as the COVID-19 has demonstrated, the technology is more important than ever.
Yeah, I absolutely agree with you. So I don't want to be, because I think some people just so sick and tired of hearing it's like, oh, there's no bubble, oh, this is just a realtor talk. But in our past episodes, we actually shows them statistics regarding the forbearance, the foreclosures, non-current loans.
Yes.
And that's the statistics that we want to show people, that if there is honestly a crash, you will see a lot of of course we have non-current mortgages, but if you compare the numbers to 2008, 2009, is actually is way, way, way lower.
Exactly. And if you've seen some of the movies, Take the Money, etc., some of those other movies, which shows what was going on behind the scene in the stock market, once I saw that, I didn't feel so bad about the real estate market.
That's true. Hey, Karen, I have this case study that I want to share with you, and see if maybe we can start this conversation regarding this one that I had, this scenario that I had. Are you able to see this chart?
I can, and I apologize if you see a cat walking behind me. We have 3 cats around here, and they all especially like it when I'm on Zoom. So I apologize.
No worries. Are you able to see the chart here?
I can. Yes, I can.
Great. So, as of course, like before we make an offer for our clients, a lot of times we have to run some kind of valuation. I blocked out the addresses here, but so we had talked a little bit before regarding how we should be providing our valuation service for consumers, for home buyers. And a lot of times we do see a lot of these computer generated quick CMA out, and then just like, here go, just look at this, and then make up your mind and see what kind of price you want to make an offer for. So we kind of feel like that is, I would feel really nervous to do it that way. So we put it together on a spreadsheet, and we really compare each of the property's conditions, not as detailed as an appraiser, but at least it's a good idea on the same page, one pager for our clients to look at. But I thought this particular one is really interesting because we had a lot of pendings in this neighborhood. And as you see that our valuation came out to about 1.316 based on the sold dollar per square foot for this property. But then we also said that, well, knowing this area is people are making such a strong offer, it could be like 1.388 to 1.466, but that will be above and beyond what appraiser probably can appraise for, because even though we know these pendings, these properties are pending right now, and we understand some of them had gone up this much, 1.46. I was like, the appraisers cannot use these numbers because they're not close.
That's right. That's right.
So then our client actually was like, well, understanding they I mean, this is, I don't know how many offers we made already, so they understand it's really competitive, so they decided to based on this, they were like, okay, it's fine, we'll make an offer 1.475, and then hopefully you know, like we can wait a little bit until that some of these close. But our appraisal came in at 1.345. And although it is not as shocking, but it's still meaning that they have to come up a lot more money, to pay for that difference in terms of what the lender is willing to loan, because now the lender is going to loan 80% of 1.345 instead of 80% of 1.475.
Right.
So what happened with this one is that we ended up doing a second appraisal, and we waited a little bit until these were closed. And
I bet that made a big difference, didn't it?
Huge difference. And so when we came back and got a much higher appraisal value, they were just ecstatic. So I thought this would be a really good example to show you, and also maybe start that conversation about, you know, this is what we're seeing nowadays on the market.
Yes. Well, one of the things that I want your watchers to understand is, first of all, let's start with the basics. And for an appraiser, probably the most basic thing that we have to recognize is, what is the definition of market value? There are different definitions of market value depending on the scope of the assignment. If you're at an auction house, actually an auction house, their definition of auction value is usually a low price. But actually what we have right now is a bidding war, which means that the property goes to the highest bidder with the best terms. And so that absolutely is not the definition of market value. So you and all of you need to understand that when an appraiser is hired by a lending institution to provide appraisal services for that loan, we're bound under the federal institution guidelines. We're completely bound by federal guidelines. That being said, there is a definition of market value that we are mandated to use. And I'd like to share that with you if I could. And I'd like to tell you what the nuances are in this definition. So the market value means the most probable price which a property would bring in a competitive and open market under all conditions requisite to a fair sale, the buyer and the seller each acting prudently and knowledgeably, and assuming the price is not affected by undue stimuli. Well, already in that first paragraph, there's another paragraph here, but in that first paragraph, what we're seeing is not the most probable price. We're seeing higher prices. Each price is a little higher. Okay, so that's number one. Open and competitive market. This is more than competitive. This is the Olympics. And the conditions which result in a fair sale, where when you have 10, 30, 50 offers, that's not a fair sale. It is, everyone's in for it themselves. They got to win. They got to win. They got to win. And then the next portion says the buyer and the seller each acting prudently and knowledgeably. Let's face it, Helen, it's been kind of a crapshoot for everybody. Everybody's been gambling on all of this because they're not sure if they're going to get this house. And the wife may say, I want this house. This is the house of my dreams. And the kids may say, I want that swimming pool. And so there's a lot of pressure on the people that are buying, keep offering a higher number. That is not without undue stimuli.
And that's also one thing, is that buying a home is very emotional process.
Very much so.
And this is all I always say, this is why you have to have a professional to act for you, because they have to take that emotion out and show you all the numbers and guide you the right way. I was like, even when I do it myself, for myself, I get very emotional, and I have to keep telling myself, okay, what would I say to my client if, you know, if my client is in this situation? So yeah.
And then your husband says to you, but honey, it has the workshop I really, really want. And the kids say, but mom, I really, really want that bedroom. No pressure, mom.
Exactly.
So let me read the second part of this. Implicit in this definition is the consummation of a sale as of a specified date. So what that means is that every appraiser has to, first of all, disclose what is our definition of value. We have to put this in every appraisal report. The next thing we have to do is usually it's the day we inspect the property, that becomes the effective date of the value. And think back to the 1989 Loma Prieta earthquake. Every property that we saw for 6 months prior to that day, we had to go back to make sure that those properties were still standing. So one day can make a difference. Again, even in the stock market, when the stock market crashed and burned, people were very concerned about property values. So a single day can make a difference. Another reason that's important, in today's world, we currently have the step-up tax basis for trusts and for estates. So when one person passes away in the estate, we have to do an appraisal as of the date of that death.
Right.
And so that's why I wanted to specify for your viewers that the date is very, very important. Now, there's 5 different components that you need to be aware of. First of all, buyer and seller are typically motivated. Helen, can you honestly say that most buyers and sellers in today's market are typically motivated?
Oh yeah, absolutely.
Well, I don't know if they are, because the seller's like, oh, I want to get as much as I can. This is a boom time. And the buyers are saying, okay, now I got the pressure. The wife wants the kitchen, the husband wants the workshop, the kids want the swimming pool, you know. So I it's not where anybody has a chance to make up their mind. My husband and I bought during a market like this in 1986. I'm embarrassed to tell you, at that point, interest rates were 13.75%. We thought we were doing great. And we signed a contract on the hood of our realtor's car, and he filled in the price once he got to the negotiating tables.
Wow.
That's how, yeah, okay. We got the house, but still it was very nerve-wracking. So that's not typical motivation. So I understand the emotions that go in this. And in the end, we were very sorry we got that house, because there was all kinds of problems with it. If we would have just taken our time and waited out the market, we would have been better off. But that's okay. That's behind us now. The number two item is that both parties are well informed or well advised and acting in what they consider their own best interests. I will say that today, the realtors of today and brokers of today are much more educated and provide much better documentation and information for buyers. So buyers really know what they're walking into. Mm-hmm. So if they know that there's a difference, or they can anticipate that there's a difference between the sales price and the appraised value, they're not shocked. So I think that your professionals, your group of professionals, are doing a great job. The next item is allowing reasonable time for exposure to an open market. Yes. In the past, reasonable time was pretty much like 2 to 3 months. Mm-hmm. Now it's about 2 to 3 hours. So that's not reasonable time. And that payment is made in terms of cash. That hasn't changed. That mm-hmm. We either have cash or we have conventional financing, which is light cash. Mm-hmm. Now, the reason that that's in there is in the 90s, there was lots of creative financing. So I'll give you this yacht, and included with the sale of the house, if you pay my price. So that's not financial terms. So that's why they put that in there, because there were other gimmies going on.
Oh,
So I'm just trying.
it is definitely happening now with like, we see people, it's like, we'll buy you a vacation in Hawaii, we'll send you a taco truck or something, it's crazy.
So then again, that ding, 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 you know that things are not conforming to market value as defined. Then the last one is that the price represents the normal, remember the word normal, consideration for the property sold unaffected by special or creative financing or sales concessions granted by anyone associated with the sale. Well, I'm not saying sales concessions, but like you said, people are, oh yes, you can stay in the house for an extra month, no problem, rent free, right? I'm sure you're seeing that all over the place.
Mm-hmm.
So when you have all these red flags that come shooting up saying that that today's prices are not conforming to market value as defined by the federal lending institutions, then the appraiser's hands are somewhat tied, because the appraiser can't just come up with data out of nowhere. We have to prove and demonstrate every single adjustment. And the other part of that is that the appraisers are licensed as well. We're held to a very strict authority with the state of California and with the federal government. And our reports are reported. In other words, if somebody turns us in for turning in a bad report or a questionable value, or if we're always coming in 500,000 high or 500,000 low, they look into us very seriously, and the state of California has the option of coming to my office at any time and reviewing all of my records. So we're always feeling like we're under great scrutiny, just like you do, but for different reasons. So that being said, if our bank or if our client hires us to come up with a definition, an appraisal with the definition of market value, what most of us do is use the very best 4 or 5 closed sales that we can find. And we try to use some more recent sales versus the older sales. Yes, we can make a market condition adjustment. Sometimes I'll use the most recent and then one almost model match from 5 or 6 months ago and show what the market's doing. Because we have to demonstrate mathematically. We can't base it on our gut level.
Exactly.
We have to show mathematically how that market condition has changed. Then many of us will throw in a pending sale or an active listing and acknowledge that most of the homes in the area are selling anywhere from 5% to 20% more than the asking price. So the pending sales of today are demonstrating the low end of the value range. Whereas maybe 2 years ago or 3 years ago, the pending sales may have been at the upper value, upper range, because the prices wouldn't have sold for more. So I hope I didn't go over that too quickly. Does anybody have any questions about the definition of market value and the difference between market value and what's going on right now?
Yeah, and just a reminder for everyone to ask your questions in the Q&A box, because we were just gonna ask questions, but I definitely have a lot of questions. But I'll go back to what you said just now in terms of market value. And us realtor, when we consult with buyers, we always say whatever the buyers, a willing buyer and a willing seller, they have this agreeable price, that's the market value of that property. But you have to be really careful explaining that to the client, is that even though, yes, you're right, because if there are like 10, 15 people who are willing to pay around that range and you kind of beat everyone else to pay that, the appraisal value in the appraiser's eyes, that's not the value that they can adjust to. They have to look at whatever has been sold. So the example I showed earlier is very typical, is that the appraisers couldn't do anything until those properties have been sold. And we were just lucky enough that our lender at the time, they saw it, we prove it to them. It's like, look, literally they turn it in and then we have one closed at that high price. So the lender was willing to let us do a second appraisal. And what happens then when, for example, if your appraisal does come in really low and it was unexpectedly low, and your lender is not willing to lend 80% of your offer price. So some of the buyers nowadays, they have to go with two lenders simultaneously, so that if this appraisal doesn't come in, then they're going to have to try out with another bank, and hopefully the other bank can come in with a better appraisal. Now that goes back to, even though appraisers, they have some guidelines how to value the property, but still two appraisers can appraise the same property within a week very, very differently.
That's very true. I think a lot of that, Helen, goes back to the education and the knowledge of the marketplace that the particular appraiser has. One of the tips I gave to our local realtors, I live in Discovery Bay here in California. We have a lot of waterfront locations, and valuing the waterfront locations has many nuances. And somebody coming here from perhaps San Mateo or from another area, Bakersfield, who really don't understand the nuances of living on these waterways and what it means to boaters, they're not going to understand the values. And likewise, I always recommend, always, for you to get the most experienced appraiser for as close as proximity to your property. And in fact, I've actually recommended to our local realtors that they might want to include in their purchase agreement. I don't know how legal it is, but give it a shot. That the buyer wants an experienced appraiser. Usually that's a certified residential or a certified general. Those people are held to a higher standard and can appraise more complex properties. And to require that appraiser is from within 10 miles, 20 miles, but that really understands the marketplace, because not understanding a marketplace can really end up in a fluctuation. Now, if you have two appraisers from within the same marketplace and with similar experience, I'll bet you their values are less than 5%. And do you want to know how I know that? The relocation companies test us. So the relocation company hires the different people that they interview to make sure that we understand that area, the nuances of the area. Then the relocation company hires two appraisers. And they do this to buy the property out for their employee that needs to move, right?
Right.
So if two appraisers are outside a 5% difference, they'll hire a third person. The person that is outside of that third appraisal may get dropped from the panel because they say that you're not fine-tuning your value enough. So if you know the area, it's certainly plausible to have appraisers within 5% of each other.
Yeah, I think that is really important. And that's a good tip in terms of like requesting a certified appraiser who is familiar with the area, because a lot of times lenders actually would tell us that we have no control. We just send it over to the appraisal management company. And then they pick their own appraisers.
Yeah, there's a lot of misnomer there. You know, that also goes under the category that the realtor is not allowed to talk to the appraiser. And I just talked to somebody today who said, oh yes, I tried to give the last appraiser comps, and that person said they can't even talk to me, let alone accept the comps. And I said, that's not, no. That's not the intent of this. Now, if you come to me and give me a wad of money in an envelope and say, I know that you'll do fine on this appraisal, I just know you'll do a wonderful job. Now that is a problem. Or if you say, if you don't come in at the right value, I'm going to see that you never get another appraisal from this firm. That's another thing. And that was going on.
In 2008, 2006
yes.
to 2008, that period of time.
Yes, that's what it was. If you can't hit this number, then you're done. You're toast. So that's a lot of pressure for appraisers to do something unsavory, shall we say. And that's not, you can't have an independent appraiser that way. And if you do, you don't want them to represent you in court. Trust me, because a lot of us do court work. So I'm recommending that this might be a temporary solution. And also you need to let your realtors and broker friends know that most of us accept the comps. We may or may not use the data that you gave us, but it's good for me to see what data you're relying on.
Yeah, and I think that is a really good point. Oh, I'm so sorry. I don't know why I didn't see all these Q&A in the all these questions in the Q&A box. It didn't.
You're asking too
me.
many questions, Helen.
I know. So didn't mean to not to ignore you guys, but it says somebody posted today on Facebook about a company called Ribbon Appraisal Protection covers the difference on low appraisals. What are your thoughts on this company? Holy cow!
What is it called again?
Ribbon Appraisal Protection. Yeah, it says covers the difference for free. We know nothing is free. I agree with you. I've never heard of it. Is there a standard or basic guide? Well, if somebody has heard about this, please do raise your hand and please, I will unmute you and let you talk about this, but I've never heard of that.
That's a new one on me as well.
It's probably kind of something like a bridge loan, and I'm sure it's going to be expensive, I would think. I mean,
nothing is free, Helen. Let's go back to the basic. Nothing is free.
Exactly. Exactly. And another question is there a standard or basic guideline for appraisers to use, such as how much more invalid does a swimming pool worth in the appraiser report? Good question.
Well, okay, that is a good question, and thank you for asking it. So first of all, in most markets, I will tell you things like solar, new faucets, new chandeliers, swimming pools, the cost that you spend on it, even your kitchen, the cost that you spend out of pocket may not necessarily equal what the market will pay. When I say the market, I mean the overall market. Let's say your favorite color is blue. And let's say half the buyers despise blue and the other half like blue. So the ones that like blue might say, oh, this is great. But the ones that despise look at it and say, oh, the first thing we got to do is get rid of all that blue in this house. So the value goes down. So to answer your question, let's use swimming pool as an example. Let's pretend the swimming pool costs $40,000. It's an inexpensive swimming pool. And let's say we're in a first-time buyer neighborhood where there might be one swimming pool for every 100 houses, so not very many swimming pools. The contributory value, and that's called contributory, is maybe $5,000 or $10,000 depending on the neighborhood. Sometimes it's a negative because the people say, oh, I'm filling that. That's the first thing I'm doing is filling in that pool, which I go, oh no, but that's what some people do. So then we have to measure the value of that pool based on a paired analysis. So it's not a manual, because let's face it, swimming pools are different costs all over the country and different appeal all over the country. Homes in San Francisco typically don't have swimming pools because it's not generally warm enough there to enjoy the sun during the summer. It's usually very cold in San Francisco in the summertime. But swimming pools in the Pleasanton, Central Valley areas are very popular because it's hot and you spend a lot of time in your backyard. Also, swimming pools in areas like Black Hawk, where it's cool, you're not cool if you don't have a pool, even if you don't use it. So it really depends on the neighborhood, and we have to individually determine the contributory value of that swimming pool based on that neighborhood and what the market's telling us at that time.
Yes, that's a great point. I think this is one of the questions that people ask all the time. So does it add value for swimming pool?
It depends. Well, I put a swimming pool at my house, and for me, it was nothing to do with value. It kept the kids happy, and I enjoyed it very much. So, you know, do what you really enjoy. It's your home.
Exactly, exactly. And Susanna asked, some of our clients think adding solar panel will add value to the property. Is that the same in appraiser's point of view? And Susanna is actually one of our agents at HAYLEN Group.
Okay, well, I'm also one of those that puts solar on, so I can attest to this in both ways. So first of all, you have to understand that there's different ways that solar is put on a roof. Some solar panels are leased, and when the solar is leased, that's considered personal property. Appraisers are not qualified to appraise personal property. So the solar panels that are leased, we give zero value to, even though there is cost savings for the buyer. we're required to give it 0 value because it's not part of real property.
Mm.
Real property, it has to be permanently affixed.
Mm.
Like a built-in barbecue is included, but a freestanding barbecue is not. Does that make sense?
Yep, absolutely.
Even though it's a great big monster barbecue, you don't really want to move it around. It's still not included because it's on wheels.
Sure.
So there's the same thing with the solar. That the solar's owned, even if they're still making payments on it, that's considered owned. And as a realtor, it's very important that you include that in your listing, whether it's owned or leased, because it really helps us appraisers out.
Exactly. Now, if it's owned, how do you value that additional value of the solar panel? Because I have seen two appraisers doing it differently as well. And one appraiser used a value of how much utility costs you're going to save over the next 30 years. And I was like, really? And it was like an $800,000 property. And then they gave an $85,000 value on that. I was just shocked. I was like, what? It sounds a little crazy.
It is crazy. So the Appraisal Institute has classes on that, and I firmly disagree with them, and many of us in the industry do, because the user now may not be the same, using the same amount of energy as the user in 30 years. The user in 30 years might be only 2 people in the house. In fact, most of us hope that there's only 2 people in the house. Whereas when you have children at home and family with you, your energy use is much higher. So there's no guarantee that that is an actual figure. So to use that, to me, seems kind of a gamble.
Mm-hmm.
So instead, I do the same thing that I do with the swimming pool. I compare homes with solar versus homes without the solar. And I take away all the other differences. And the only thing that stands out is one has solar and one does not. And once you do that, you can see exactly what this particular market is paying for solar, not just coming up with some kind of calculation. Let's face it, Helen, your market and my market is not that sophisticated to figure out what their solar costs are in 20 years, but they do know how much they'll pay towards it. And usually, from what I've seen, it's anywhere between 5,000 and 50,000, depending on the extent of the solar system.
Yeah, I was expecting somewhere around there, or maybe even 30,000. I feel like that would be a brand new one, but yeah, I was really shocked with that one.
Yeah, I'm not a fan of that method. But that was a very good question. Thank you for asking that.
Yeah,
and it's very appropriate in today's world where solar is a big portion of it. Solar costs a lot. Solar is not cheap.
Yeah, absolutely. And Celine Simon, and Celine is the one who referred Karen to speak today, and she's also one of our HAYLEN's agents. Celine says she loves your cat, by the way.
See, yeah, there he is. Wait a minute, let me show you. Yeah, there he is.
Hey there. So I would like to ask you, all right. So Celine said, as a realtor, what if anything can we as realtors do to challenge an appraisal or ask for reconsideration of an appraisal short of going to another lender?
That's a great question. That's a really good question. The first thing you have to realize that whoever the appraiser that prepared the first appraisal, he or she is going to try to defend their decisions right to the very end. On the other hand, if you go in and humbly say, I was wondering if you would reconsider or take a look at this data and see if it would have any effect. And we're required by the lending institutions to review the data that you provide. And we can comment why we did not include it. Mm-hmm. Now, what I found is that sometimes when people bring me the extra data, it's sales of homes from completely different school districts, from a different part of the town, completely different size house. I mean, there's so many differences that you kind of go, oh. But if you go in there honestly and just say, hey, I know that this is a challenging market, but would you consider this data?
Right.
And normally, if you go in with that attitude, not a what's the matter with you?
Exactly.
With a bad value.
Exactly.
But if you come up with kind of a humble approach of would you reconsider? Would these help?
I absolutely agree with you. And actually that goes to the next question Susanna is saying, because I was about to say this too. She said, I heard many agents' feedback is disputing an appraisal's report is almost impossible or rarely be successful. Is that true, and why? Because we have done appealing. We pretty much, when we don't get a really good appraisal value, we have to advise our clients, honestly, we will appeal it, but we would say 90% of the chance they're not going to change the number. And I absolutely agree with you, is that we have to ask, when we ask that question, it has to be really not in a attack mode, saying like,
Right.
why would you come? I mean, obviously we feel that way sometimes, like, oh my gosh, how did that come
You
up to this
stupid
value?
appraiser. What's the matter with you? Boom, 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 boom.
But you really can't. If you want somebody to be cooperating with you, you can't do that. But still, even then, it just really hard to find. It seems like really hard for the appraiser to be willing to change the value in the end. I mean, I don't know, maybe you have different kind of experience from the appraiser's point of view.
Well, like I said, if you approach it appropriately, that's number one. And number two is that if your data is really truly appropriate, you know, sometimes it's very disappointing to you as a realtor that you didn't quite hit it and your people were so close and there was $3,000 difference, things like that. And everything's very crucial. Today's market, it's probably not as much so. But if you approach the appraiser with adequate data, sales data, that shows that maybe they didn't know, maybe they didn't see this comp, because sometimes that happens. Maybe you did not see this one that didn't make it to the marketplace, and that might happen too. And there's been many times where I've gone back and revisited and said, well, had I known that, if it was in MLS, that would have been a big help.
Yeah.
So I'm not saying that you're always going to get a value change, but it's certainly plausible if you approach it from a business point of view.
Absolutely, absolutely. And I have another question, is that because sometimes, like, of course, within this neighborhood, right? And as example, the city of San Jose is huge, and there's different neighborhoods. So within this pocket of the neighborhoods, maybe all the homes, most of the homes, like about 1,500 square feet. All of a sudden, you have this 3,000 square feet home right there, and it's beautiful. You cannot find comps. You have to go to the next block, or not next block, but next neighborhood, maybe across either a highway, expressway, or just a major road. It's a different neighborhood to find more comparables. So in that situation, how do you do that?
Oh, you know, it's funny that you would say that, Helen, because whenever I drive up and I see the most unusual house on the street, I know that that's going to be my subject property. I'll drive up, I'll go, oh, no, really? And the most unique one, the house outside of the house looked like a castle. Yeah. And it was amongst all 3,000 square foot houses. And then there's this castle. And I had an associate with me, and she looked at me, she said, if I see an armored guard standing, you know, at the door, I'm leaving. We're not even going in, Karen. So yes, regarding the unusual house, we run into that a lot. So I try to find the largest model in the subject neighborhood. So let's say you're in Willow Glen, and you've got a 3,700 square foot house with all kinds of room additions. I mean, the whole family can live there. And there's a swimming pool, and there's solar, of course, because that's the way it goes. So what I typically do is I find the largest Willow Glen sale, because I've got to measure what the difference of value is between this new house and something actually in the Willow Glen neighborhood.
As and how far from this sale? 6 months?
Well, I'll go back as far as I have to, just to show what the largest house. Then I'll try to find something recent in the Willow Glen area. So I've got old and new, super big and probably more normal size. Then I say, okay, so this buyer specifically wanted this neighborhood, but wanted a monster house. Where's the monster houses? And so then I go to other neighborhoods that have, again, an over improvement over here. That we call that an over improvement, where you've got this monster house in a regular neighborhood, and then I try to find those all around the place. And sometimes those are 2 miles away, sometimes they're 3 miles away. And I normally note in the appraisal that the appraisal is not going to conform to normal CU standards because of the distance, but it was necessary to demonstrate what the value is of this home, which is an over improvement. Right. Then you look at your comps that are closest in proximity, and then you're able to see how much the difference is between the homes in the other neighborhoods versus the Willow Glen neighborhood. And so that's how we approach it. It's a lot of work, and we really spend a lot of time. Most of us spend a lot of time on that. It's not a cookie cutter. In fact, I predict that you're going to need appraisers for more of that type of property instead of the cookie cutters. Yeah. I don't believe that you're going to need appraisers for cookie cutters long into the future, because you can do a lot of that online. And that it's where you've got the unusual stuff, where you got the solar, you got swimming pool, and you got the $80,000 kitchen. That's when you really need a professional to really, put their eyes on it and really do their magic.
Just real quick, since you talked about online valuation, how's your opinion about Zillow valuation, Redfin valuation, and all kinds of online automated valuation?
Okay. So let's start with number one. First of all, the court system will not accept Zillow sheet from either the divorcer or the divorcee. That's not accepted. They want a live appraiser to go out to the property, to assess the property, and to determine the condition. That's number one. Number two, you really and truly don't know what the parameters are that those valuations give. Mm-hmm. Are they staying in the same neighborhood? Are they just using the zip code? Well, the zip code can have all kinds of neighborhoods, can't it? Yeah. Are they saying just in the county? What about the school districts? I mean, none of that's taken. It's just algorithms, and it's just numbers, and they flesh them all together, and they shake them up, and then they average it, and that's it. And I can't tell you the number of people when I go into their home that say, well, I got my Zillow report. And I go, well, that's good. Throw it away.
Exactly. When our clients tell me like, well, but the Zillow said this, Redfin said this, and I get it. And that's why I like to show our spreadsheet. And even I do that for myself too, for my own property. And just actually literally just last night, I looked at Redfin and Zillow, $300,000 difference on my property.
Oh, yeah. Imagine what it is for waterfront.
Yeah, exactly.
Zillow doesn't even know what water is. So, what I do tell homeowners, and this, you might want to remember this. If you have the worst house in the nicest neighborhood, use Zillow. If you have the nicest house, forget about it. It's not going to know about any of your goodies, about any of your upgrades and the special things that you've done. But if you've got the very worst house, the very, very worst one, Zillow's great for you.
Yeah, you'll be happy. You'll be really happy.
Yeah, you can't get a loan with it.
Well, now we have about 4 minutes left. I have 2 more questions. Anthony, okay, who is actually also helping us out here in the background, he sent a message saying that considering the condo market has been quite slow since the lockdown in 2020, how do appraisers go about appraising units that may not have similar sold comps within the past 6 months, different floor level, etc.? Great question.
Yeah, that's a very good question. Thank you, Anthony. Yes, we still go through the same process. We do the same process and do our very best to get the most comparable data possible. The one thing that I think many of us appraisers have learned as a result of the pandemic shutdown is that many of the condominium units where you go downstairs and get your Starbucks and you go downstairs and get your Danish, and you didn't really cook gourmet meals and you didn't really barbecue, and you were stuck inside 4 walls. Whereas everybody that that lived in houses, well, they were barbecuing and they were sitting in the backyard playing ball with the kids. They were cooking, and you had more elbow room, and you didn't have the guy next door playing a stereo too loud, and et cetera, et cetera. So the demand for condominium properties as a result of this pandemic has declined. Mm-hmm. Now, some people like it due to ease of maintenance, things like that. But many people that formerly owned condominiums are moving east, moving towards Brentwood, Livermore, Tracy, even Stockton. And Anthony, you brought up one other point, if I may. As a result of the pandemic, more people are able to work at home now, which we didn't think that was possible 5 years ago, 10 years ago,
Yeah.
ever.
Yeah.
And now many of the employers are saying, yes, go ahead, stay at home. It's okay. And so that being said, the smaller condominium space doesn't necessarily always feel good. Whereas if you have a single family house, sometimes that feels better. You got more elbow room, and you can go out in the backyard, you go mow the lawn if you want to. It's just something, it's different than a condominium.
Yeah.
So we're just seeing that for I think it's temporary. I think people will go back to condominiums, but being shut down as long as they did, everybody's looking for a 4-bedroom everything, as you probably know.
Yeah, and is what's interesting is that just pre-pandemic, pre-COVID, all the developers were talking about building micro units. They were really proud of the fact that I built something like 200 square feet only, and now if you look at the news everywhere, they talk about like, oh, bigger homes, more rooms, we need bigger homes, bigger homes. So just like that, we changed the culture, changed how people live.
Yep.
And Susanna has another question. Can we use better school district to support the higher appraisal value, or appraisers strictly look at major roads and distance as boundary?
No, school districts is a major factor. I see changes, I see value differentials based on the school district boundaries. And that's why in many communities, parents get very, very, very upset when the school boundaries change for any reason. We lived in Fremont for 28 years, and they changed the school boundaries, and it was quite dramatic. Whereas people moved, including myself, to different areas so that my children could go to certain schools. And other people do the same thing. And I think, in my humble opinion, I think many parents or prospective parents will buy in an area if they know it's a good school district. I think that's a very important factor. So the definition of the market area is a variety of things. It might be the school district delineation. It might be street delineation. It might be how far you are from the freeway. So don't ever let anybody tell you that a market area is bound by certain streets. That is not, the banks make us say that, but it's not true. The actual market is based on what the marketplace is telling us, and schools is right at the top.
But with the appraisal report, there is no row that says specifically for school district. And actually, that's really interesting because, as you saw my spreadsheet earlier, we have schools as one of our column. And we actually, when we provide comps for our appraiser, especially knowing if that area, that boundary is like next to maybe a complete different school district, we point it out to them. This is a complete different school district for here. So if you are going to provide comps, I would say, I mean, not sure if the appraiser is familiar with that area or not, then maybe you should point that out as well.
The appraiser can discuss it and should discuss it if there is an influence. The problem with it is the opposite problem than what you think. If there are schools that are known for poor scores, increased crime, etc., the appraiser has to, we can't specifically state those things because that is on the verge of quote unquote redlining. And so redlining is the precursor to the what do you call it today? The social, the sensitivity to race relations is probably what I'm trying to say. Right. And it's not just race, it could be culture. I mean, there are certain cultures that really enjoy living in a similar community. And if you say this school district, or for the appraiser to say that, is superior to that school district, we have to, then they'll say, why is it superior? Well, it's not just school scores, So, but you as a realtor, you don't have to, you're not conforming to federal guidelines like we are. That's a federal jurisdiction over us that another good example is that we can't call out if there's graffiti.
Really?
Yeah.
You cannot call out graffitis? Wow.
Nope. We cannot call out if it's a high crime area. We're not allowed to do that. Our hands get slapped.
Wow, I actually really surprised. I didn't know about that.
And believe me, in the last 40 years, I've been in many high crime areas. and so I just have to use the data from just that area and let the data speak for it. And for me not to verbalize what I've seen or
Yeah.
Like I said, the fact that we work for federal, excuse me, it changes. That's how we're different, how realtors and appraisers are different. I answer to the federal government.
Yeah, and I guess like for us, we would specifically say like, for example, these are the best comparables because these belong to the same school district, while these are different school districts. So obviously you don't have to say like this is so much better than this
Right,
school
right.
district.
But
Yeah.
we have to explain why.
Right.
But
True.
you don't have to do that.
True.
Yeah.
Great. And last question is that, are there any special assessments made for properties that have grandfathered zoning?
Oh, those are a pain. Okay, so here's what you have to know. If you have a property that is that the improvements have been grandfathered. So let's say you have a single family residence on a commercially zoned property.
Mm-hmm.
So the first thing that you need to do as a realtor is go down to the city hall and find out if that house is burnt or destroyed more than 50%. Can it be rebuilt? Because if you don't do that, the appraiser will. And in the cases where it cannot be rebuilt, the appraiser will blow up your loan. Sorry about that. I'm just being straight with you. Because we're required to address whether the house can be rebuilt or not, or the structure can be rebuilt if it's been grandfathered and if it's no longer a conforming use to the current zoning.
Got it. Got it. I actually have so many more questions, and we're already 5:19. And
This went by quickly.
I feel like we need appraisal part 2.
I'll be happy to do that with you, Helen. This has been a lot of fun. And I enjoy sharing some of my information with your viewers, and I'd be more than happy to do it again. And I've got 2 more cats that you've got to see.
Oh my gosh. Yeah, they will have to share their opinion as well next time.
Yeah, that's right.
Yeah, but I really truly appreciate it. And then I know I honestly have written some other questions, but I know we're way over, but we definitely would love to bring you back. And this session is going to be recorded. It will be posted on YouTube. Give us about a week or so. Next week we will send it out to everybody and also post it on YouTube. So be sure to subscribe to our YouTube channel as well. So again, thank you so much again for being here. Really appreciate it. It was such a great conversation.
Thank you. I had a great time, and hopefully somebody learned something. So this is good.
Absolutely. Is there any other topic that you would like me to share with you? Please do make some comments below, and I make sure that I will read every single one of them. See you soon. Bye.